Welcome back. You're still tuned into Markets Today. Let's go to the rest of the headlines that we are tracking for you. To the fourth headline now. Nykaa gained close to 3% after the company posted a decent set in the second quarter. Mangala Malu is here with the details. Mangala.
Nykaa reported a rather decent set of numbers in their second quarter. If you just take a look at it, their revenues grew by around 7% quarter-on-quarter in what is a seasonally weak quarter. But the key, positive from the numbers was a 33% jump that we saw on their EBITDA, which meant that the margins have expanded by about 100 basis points quarter-on-quarter. Importantly, the net profit on an optical basis is lower, but that's primarily on account of higher depreciation, finance costs, tax, and lower other income. The key thing to watch out for will be what the management has to say with regards to improvement in their performance in the third quarter, which is a seasonally strong quarter for Nykaa.
Okay, Mangalam, thank you so much for joining us with all those details. So that is about Nykaa. But tell us more about Delhivery. So 10%. What is happening here?
Well, there are a bunch of reasons why Delhivery could be higher in today's trading session. The biggest reason is the kind of drubbing that we've seen in all these stocks. So in fact, in the last 1 month itself, the stock is down almost 35%. From its post-listing highs, it's down 46%. And from its issue price of 487 as well, it's down around 22%. The key reasons for the big sell-off that we saw, it started off when the company reported its second quarter update, which suggested weakness in sentiments as well as volumes. And the fact that their capex took longer than expected to stabilize. And the street was worried about the integration of the B2B acquisition that they made of SpotOn. But importantly, now the street is fearing that there could be a fair amount of supply coming in on November 19th as the pre-IPO lock-in ends as well. But recently, we've seen a pop from the lows in a lot of these new age companies. So case in point, in the last couple of trading sessions, Nykaa is up 23%, Cartrade is up 20% from the lows. And why just that? We saw a big fall in names like Paytm, Zomato as well. Zomato itself is up 55% from the lows. So that is something that we'll have to watch out for. Nykaa reported its second quarter numbers today, and they weren't very bad. In fact, now the street is expecting that there could be some pickup in the third quarter on account of festive season, and Delhivery's second quarter numbers are on November 11th itself. So those are a couple of things that the street will be tuned into. But the key reason why it may be up is because of the big drubbing that it has seen, and maybe someone is finding value here.
Oh yes, 10% higher in Delhivery today. But moving on, the fifth headline today, L&T ended the day flat after the company posted a good set in the second quarter with a robust order inflow. Vivek Iyer is here with all those details. Vivek.
Well, that's right. So L&T, very good quarter. Company, in fact, has indicated that they managed to meet the higher end of the targeted inflow band of 12 to 15%. The only sore spot, as far as the numbers were concerned, was the core EPC margin, which the company attributed to a weaker product mix, a project mix, also on the back of very volatile commodity prices. A couple of key highlights from our conversation with them. First is, as far as an update on the road projects is concerned, the company would be selling the entire road projects business in this particular quarter. They expect to complete the sale by end of FY23. When it comes to the Hyderabad Metro, analysts were expecting that too would happen soon. However, the management has indicated that the first priority there would be to reduce the debt as far as the Hyderabad Metro is concerned, improve the operational metrics, and they probably pushed it out a couple of years. When you're talking about the ROE guidance, very importantly, the management has indicated that they are looking to increase ROE by 1 to 1.5% on an annual basis in the next couple of years, and that is something that a lot of analysts will take a lot of heart from. When it comes to brokerages are largely positive on the number. CLSA says that margins are likely to improve from fourth quarter FY23 from lower commodity prices. HSBC says that the divestment of ROE dilutive businesses is something that augurs quite well for the company going forward.
Assets are in form of the stake in IDPL, because the IDPL is a subsidiary that is actually holding all these assets. Every asset is unique, so it has its own discrete cash flow. Being a very price-sensitive information, before the document is synced, I am not authorized to announce the value. But suffice to say that we are getting a fair value for the assets that we are exiting. We are into the documentation discussion phase, so I expect by the time this calendar year is out, we would have inked the document. Like anything else, I think we need a hell a lot of approvals from various authorities. So that is going to take 3 to 4 months for getting the various NOCs. At the beginning of the year, we told ourselves that we need to have 30 basis points improvement over the reported margin of the previous year, which was 9.2%. So we were shooting at 9.5%. We didn't anticipate the supply chain to stay broken and the war to continue the way it has been so far. So to that extent, I think there has been some headwinds in terms of the supply chain getting back to order. We are targeting to be at least 1% higher than what we were last year. And I think incrementally every year till 26, you will see this 1 to 1.5% increase.
Okay, that is the word coming in from L&T. Moving on, Whirlpool India fell by nearly 1% after reporting a disappointing set of numbers in the second quarter with a 7% fall in revenue on a year-on-year basis. Vaishta Unwala is here with the details. Vaishta.
Well, Whirlpool Q2 FY23 numbers were out today and it does not look very appealing. The revenues were down 7% to 1489 crores, which is to be compared with the street estimates of 1747 crores. The EBITDA has come down by 45% on a year-on-year basis to 72 crores, and the margins have nosedived to 4.8% versus 8.1% in the same quarter of last year. This is to be compared with the estimated 6.2%. The PAT has also declined 47% on a year-on-year basis to 41 crores. So definitely doesn't look like a good set of numbers.
Okay, that is about Whirlpool. But Vaishta, Bharat Electronics gained over 1% in trade on the back of fresh brokerage calls. What are the analysts saying?
Well, for Bharat Electronics, the street is in fact quite happy with the numbers. The Q2 FY23 numbers were released in the past week, and the management has given some strong commentaries. The Q2 FY23 revenues growth is estimated at 15% and they are on track to achieve that. The lower band of the margin guidance has also been revised upwards from 21-23% to 22-23%, and in the long run they are expected to clock even as much as 24%. The order inflows shall comfortably be beyond the 20,000 crore mark. Also, Bharat Electronics has recently set up a new plant of lithium ion cell and battery packs in Pune with a small investment of about 40-50 crores. Also, the announcement of the fourth positive defense indigenization list includes some 40 items which provides further revenue growth potential specifically for Bharat Electronics. Also, there are no delays in receiving any kind of payments from the government, which has led to a rise in the cash balance for this company as on 30th of September 2022. While the street is quite confident on the long-term prospects of this company, given its strong order book, the order pipeline, which is quite high, the recent MOU in hydrogen fuel cell, also there's a diversification in newer business verticals like hydrogen fuel cell, EV batteries, and there's a greater focus on the export markets. The company is expecting approximately $60 million of export revenues in the ongoing financial year. The company is also ramping up their non-defense businesses in e-mobility, in infra, in railways, in smart cities, etc. Now, in terms of brokerages, Phillip Capital has a buy rating on the stock with a target price of 122 rupees, while Jefferies also has a buy rating on the stock with a target price of 130 rupees.
Okay, that is about BEL. Time to focus on the auto sector now that has seen mixed sales in October. While Tata Motors, Escorts, Ashok Leyland see year-on-year growth, Bajaj Auto and Maruti Suzuki have seen a decline. Sonia Shenoy is here with the report card. Sonia, how do these numbers look to you?
Well, thanks a lot for that. So, it was a mixed bag this time around for the auto sector. And let me begin with Tata Motors. As you rightly pointed out, very good growth coming in for Tata Motors in the passenger vehicle segment, specifically because of the big boost that came into the electric vehicle space. So, overall, Tata Motors sales growth was 15.5% year-on-year, led by the passenger vehicle sales, which was a growth of 33%. And here's the big kicker for Tata Motors. The EV sales went up 158% year-on-year, coming in at 4,277 units. In fact, the entire commercial vehicle pack has also improved. So Ashok Leyland and Eicher reported good commercial vehicle sales this time. Ashok Leyland total sales were up 34% year-on-year. Eicher Motors domestic commercial vehicle piece rose 14.2% on a year-on-year basis. And the other big pocket that moved this time, which was very strong, was tractors. Both Escorts and M&M reported cracker sales this time around. Escorts total sales were up 7.2% year-on-year, up 18% month-on-month, while M&M recorded its highest ever tractor sales in a single month, more than 50,000 units. Now, on the weaker side, exports have been under pressure as we know it, and that reflected in Bajaj Auto's numbers. So the total sales were down 10% year-on-year at 3.95 lakh units. Exports for Bajaj Auto were down 31%, and the management said it would take a couple of more quarters before the exports return to normalcy. And the other set of numbers that disappointed the street was Maruti. The total sales were down 5% month-on-month, coming in at 1.67 lakh units versus 1.76 lakh units last month. The management said that the numbers are not comparable year-on-year because same time last year there was a huge supply side issue due to the semiconductor shortage. So Maruti and Bajaj Auto disappointed the street. But X of that, commercial vehicle space, premium side of the market as well as tractors did very well in this month. Back to you.
It take probably another couple of quarters before normalcy starts to return. That's been our experience in the past when we've gone through these cycles. At a retail level, every month is better than the previous month. And that is very heartening because it indicates that the markets are digesting at least the price increase which is taking place because of inflation. Actually, our shipments are running behind retails. So I would say that there is every progressive month, exports should see a rise over the previous month. Retail story is a story of tale of two halves, actually, the upper half and the bottom half. And it's been a good festive, very robust festive, which has lifted the business, and the quality of the sales and the quality of growth for the industry and of course for Bajaj has been very good.
Okay, that's the word coming in from Bajaj Auto, and with that, it's a wrap on this edition of Markets Today. Thank you for watching.